Hi, everyone. Mike White here. Welcome to this week's blog post. This week, I want to share some information with you and a little bit of background and hopefully set you up for, awareness, because there's going to be some things happening in the markets in the next week or so that it's important for you to be aware of and may have some impacts not only on the housing market, but interest rates and maybe customer sentiment. And so it's important that when these things happen, that you're at least aware of them. And also to be aware of the fact that there is also going to be a lot of interpretation of what the numbers mean, what the information that came out will translate into. And, none of us are immune to social media and to points of view perspective. And, if we're in the housing industry, we all know, in the mortgage side of things, there tends to be a lot of media bias, downplaying the strength of the housing market and the opportunities that are there. And it's something we've dealt with, but it is something that you have to put into perspective and make sure that you're getting information and seeing points of view so that you have perspective to share with your clients and your referral partners. And so we need to be aware that things are going to happen and what the market's reaction may be to them, whether it's a short-term reaction or a longer-term reaction. But we have to be careful to look at the facts and make sure that we're viewing a variety of sources so that we have a clear view of what actually things mean and what's going on, so that we can more accurately share information and serve those in the markets that we take care of. And I say this because, again, it's not hard for people to have a negative connotation of the housing market right now. We've heard the complaints year in and year out about inventory and all these other things, and yet we've had record-breaking home sales in 2018, 2019, and 2020. I'm not exactly sure why all this negative bias with all the strength of the housing market, other than the fact that it can be very frustrating for some people to deal with multiple offer situations and increasing prices. But just yesterday, information came out in the mortgage arena about applications, and they come out every week. And last week, the information came out yesterday, and last week purchase loans were down, applications were down 3%, and overall refinances were down significantly, more than that. But again, not surprising considering where this market has been. But you wouldn't have heard a pin drop for the people still praising the strength of the housing market, but there was a rush for people to explain, here we are, housing bubble, it's all going to fall apart, applications are down, nobody wants to buy houses, everybody's frustrated and done. And what they failed to see in that report, if you read into it, was the fact that there was a significant increase in all cash buyers. And so if you put all the numbers together, yes, mortgage applications were down 3%, but a significant number of all cash buyers came into the market that were buying that more than offset that. So actually, there was a total increase in the total number of houses sold, except the fact that, people who pay cash don't fill out mortgage applications. Good reason why those applications would be down. And I don't necessarily know that any of us are declaring, the housing market over because of a 3% decline in mortgage applications, especially when I'm hearing from the streets that it continues the multiple offer situation, people looking for houses 2, 3, 4 months, making 5, 10 offers before they win one. So let's just be clear that, information that's going to come out in the next week is going to be important. Make no bones about it. The interpretation of that information, the short-term, long-term effects of it. Again, tomorrow, the jobs report for May is coming out. Now, last month, when the April jobs report came out, it was a huge miss. There weren't the number of jobs that were, should have been created or were anticipated to be created. It was a huge, devastating miss. Okay. And in a lot of those cases where the miss, a miss like that comes in, that information can be disappointing and whatever. And the markets for that reaction decided that mortgage rates went higher, and the bond market went up. The prices went up significantly. Bond prices came down, and we saw about 110 basis point move to the downside in bond prices, which caused rates to go up a little bit. But within a week or so, things leveled out. We recovered most of that loss. Tomorrow, we're going to get those jobs numbers. No idea what those jobs numbers are going to be, and more importantly, I don't have any idea what the market reaction can be to those jobs numbers. But you need to be aware that it's happening, because it could be another huge miss. It could be what they anticipate. It could be a huge improvement. And the market may take that information and react accordingly, and people will react accordingly to that information. And I think it's important that you're aware that these are big, important numbers, and they could impact the markets and create volatility. Next Thursday, there's going to also be some inflation data that comes out. And again, we all know that if you're in the mortgage business and you're dealing in long-term interest rates, the worst thing that can happen is inflation. If inflation scares people that are holding bonds, it's a long-term commitment. If rates, start to trend higher, people are always going to panic to the high side. If inflation tends to be under control, and rates can continue to move, and people are less panicked about a long-term situation. The reason I'm giving you this is because we have seen significant price increases and inflationary pressures, but the Federal Reserve has classified that as transitory. And the word transitory for them basically means that because of the unemployment situation, because of coronavirus, because of people not being at work, supply and demand is temporarily out of balance, which means there are less goods around, so the price of those goods goes up. But as soon as everybody gets back to work and everything's fully open, that they should be a restoration of the supply chain, and that prices should go back to where they were. Now, whether you believe that or not, whether the market believes that or not, whether it's true or not my position to tell you, but that's the story, and that's the position the Fed has taken. And whether or not other people in the markets believe it, support it, whatever, it's a piece of information that could change consumer sentiment or could change market conditions. So again, tomorrow morning, 8:30 Eastern time, you're going to get the jobs report. It would probably be a good idea to pay attention to it and see what the reaction is and what some of the commentary is, and look around and be aware of it. The other thing is, next Thursday, you're going to get some inflationary data that's going to come out, and reports are going to come out. You probably want to be around. You probably want to pay attention to it. And as always, let's be honest, when information's coming out that it could adversely affect the marketplaces, you need to be aware. Now, most people that I'm working with are not floating large pipelines of loans. People have adopted the position in this market of volatility. If you like it, lock it, or locking things when they go into contract to close the deal so that they're not having to worry about it. My position has always been, going into these things, if you've got customers that are very rate sensitive, you better make them aware of the situation. You should be aware of the situation yourself. It doesn't mean rates are going to go higher. It doesn't mean the rates can't go lower. It just means tomorrow, next Thursday, there's going to be information that comes into the marketplace which could impact the market. And as we all know, rates go higher much more quickly than they go lower. And so people are always happy if the rate's lower than what they thought. They're never happy if the rate's higher than what they thought. It's an emotional thing that you have to be prepared for. So hopefully this information you'll find helpful. As always, if you have questions or comments, it's Mike, imtcoaching.com. We'll talk to you again next week. Take care.